One number has correctly called every U.S. recession for the last 70 years. 10 for 10, no misses. And right now, in 2026, it's making its next call. The only question is whether you can read it before everyone else does. Because if you only watch the news, you think you already know what's coming. A war pushing up oil. Inflation that won't fully die. The weakest jobs report in months. Every headline points the same way. Toward trouble. But that one number, the signal professionals actually trust, is saying something that flatly contradicts the panic. Crash or calm. Right now, they disagree. And almost nobody watching tonight knows which one to believe. Here's how close this gets to you. Somewhere in America, someone locked a mortgage rate this morning. Not because their bank changed, not because their credit moved, but because that same signal twitched overnight, 7,000 miles from any mortgage office, and quietly decided what the next 30 years of their life would cost. So here's the deal. By the end of these 20 minutes, you'll read that number yourself and answer the only question that matters right now. Is the economy actually heading for a crash, or is the bond market seeing something far calmer than the headlines? Is the Fed about to hike or cut? And is your money, your mortgage, your savings, your retirement, sitting on the right side of what happens next? 3 signals, one answer the news can't give you. Let's go get it. Here's what's coming, in order. The one recession signal every professional checks before anything else, and what it's actually saying right now, which is not what the headlines are screaming. The reason 2 smart economists read the same economy this month and walk away with opposite forecasts, and the single number, updated every day, that tells you more about your own mortgage than your lender will ever volunteer. Miss that third one and you could overpay by tens of thousands of dollars without ever knowing why. One rule first, because everything after this depends on it. Bonds and interest rates move in opposite directions. When rates rise, the price of existing bonds falls. When rates fall, bond prices rise. That's the entire mechanism. A bond that pays a fixed amount becomes less attractive the moment a newer bond offers more, so its price drops until the return matches the market. Keep that rule in your back pocket. Every number in the rest of this video is that same rule, playing out in real time in this specific year. Here's where things stand. The Fed's benchmark, the federal funds rate, is sitting at 3.50% to 3.75%, held at that level for 4 meetings in a row. The 10-year U.S. Treasury, the bond that actually prices your mortgage, is yielding around 4.5% to 4.6%, near its highest level in about 2 months. The 2-year sits close to 4.1%, and the 30-year fixed mortgage, the loan most Americans use to buy a home, is averaging around 6.55%, its highest level since last August. None of these are fixed in stone. They're moving this week for a specific reason, and that reason is where the whole story starts. The reason is oil, and it's been on a roller coaster. Renewed fighting involving Iran pushed prices up. A brief ceasefire pulled them back down through June. Then the collapse of that ceasefire sent them climbing all over again, and rising oil feeds directly into inflation. Bond investors hate inflation more than almost anything because inflation quietly eats the fixed payments a bond promises to make. So when oil spikes, Treasury yields tend to spike with it. Investors demand more compensation for holding a fixed payment that inflation is about to erode. That's why your mortgage rate right now has less to do with the housing market and more to do with a conflict on the other side of the planet. Now watch the rule from a minute ago do the rest of the work. You can literally watch the mechanism run in both directions this year. Earlier this spring, inflation, measured by the Consumer Price Index, ran up to 4.2% in May, the fastest pace in 3 years, driven by that same energy surge. Yields rose. Mortgages got more expensive. Then in June, that oil dip pulled inflation back down to 3.5%, the biggest single-month drop since 2020. And the mechanism ran in reverse, with yields easing on the news. Same rule, both directions in the space of a few weeks. And here's what that rule does to a real person. A buyer today, borrowing $400,000 on a 30-year fixed at roughly 6.55%, pays about $2,542 a month in principal and interest. The same loan at the 2021 all-time low of 2.65% would have cost about $1,612. Same house, same buyer, same lender. A swing of roughly $930 a month, driven entirely by what bond yields did over 5 years. One rule. That's all that changed. There's a second force this year that has nothing to do with oil: leadership. The Fed has a new chair in 2026, and he's stripped out something markets relied on for over a decade: traditional forward guidance. In plain terms, the Fed used to signal its next move well in advance so markets could prepare calmly. That signaling has been deliberately reduced, so every meeting stays driven purely by incoming data, not promises made months earlier. The side effect? Nobody. Not analysts, not traders, not you. Gets an early warning anymore. Every Fed meeting this year carries more surprise potential than it used to, which brings us straight back to the question I asked at the top. So, hike or cut? Here's where it gets genuinely interesting. Right now, the data isn't just ambiguous, it's at war with itself. 2 different measures of inflation, pointing in opposite directions in the same economy. Start with the case for a cut. The Consumer Price Index just cooled hard, down to 3.5% in June from 4.2% in May, with the core reading, stripping out food and energy, falling to 2.6%. That's the biggest monthly drop in years. Stack on June's jobs report. The economy added only 57,000 jobs, badly missing expectations that sat closer to 115,000, with unemployment ticking up to 4.2%. Cooling inflation, cooling labor market, both scream cut. Now the case for a hike. The CPI isn't the gauge the Fed actually targets. That's the PCE. And its most recent reading is still running around 4.1%, with core near 3.4%, more than double the Fed's 2% goal. Add the ceasefire collapse pushing oil back up, which threatens to stall that disinflation before it finishes. And the Fed's own people aren't convinced it's over. 9 of the 18 policymakers now pencil in at least one more hike by year-end, and their updated projections point higher, not lower. Hot core inflation, rising oil, a hawkish Fed, all screaming hike. Same month, same economy. One gauge says the fire's going out, the other says it's still burning. That disagreement itself is the information. It means volatility, in both directions, is the realistic expectation for the rest of the year, not a calm, predictable path. But notice what still hasn't been answered. 2 gauges fighting over hike or cut is one thing. The bigger question, the one from the first 5 seconds of this video, crash or calm, that verdict isn't hiding in either of these gauges. It's in a completely different signal. So let's stop listening to opinions and go read the one number that has never lied. Start with something that should be behaving normally and isn't. Usually a war pushes bond yields down, not up. Investors call it a flight to quality. When a geopolitical shock hits, money rushes out of stocks and into U.S. Treasuries, pushing prices up and yields down, sometimes within hours. That's the textbook pattern. This year keeps breaking it. Because this conflict isn't just a geopolitical shock, it's an oil supply shock. Instead of pure fear driving money into bonds, rising oil drives inflation fear, and inflation fear pushes yields up. 2 forces, same war, pulling the bond market in opposite directions. And this year, inflation fear keeps winning the tug of war. That's a genuinely unusual setup, and part of why 2026's bond market is so hard to read on instinct alone. You don't need a Bloomberg terminal to watch this disagreement play out in numbers. Futures markets currently price the odds of a hike at the July 29th meeting at roughly 1 in 5. Most traders expect one more hold, but look further out, to September, and the odds of a hike jump to a little better than 1 in 2. Some desks put it above 60%. That gap between July and September tells you something precise. The market isn't confident inflation cools fast enough on its own. It's betting the Fed waits for 1 or 2 more data releases before acting, not that it's decided against acting at all. Reading probabilities like this, instead of the loudest headline, is exactly how professionals separate noise from signal. I'll admit something. The first time I tried to predict a Fed decision from headlines alone, I got it wrong, because headlines chase the loudest opinion, not the clearest signal. The bond market doesn't care about opinions, it only cares about the signal underneath them. So let's go find the one signal that has never been wrong, the one I promised you in the very first 5 seconds. Here it is, the yield curve. It's simply the yields on U.S. Treasuries, plotted from a few months out to 30 years. Right now, the 3-month bill yields about 3.7%, the 2-year about 4.1%, the 10-year about 4.55%, and the 30-year around 5%. Plotted out, that line slopes upward, left to right. Short rates lower, long rates higher. That's a normal yield curve, the shape it takes most of the time, because tying up your money for longer should pay you more. Nothing alarming there, which is exactly what makes the next fact land. Remember the promise from the first 5 seconds. One number that's called every U.S. recession for 70 years, 10 for 10, no misses? This is it, the shape of that curve. And here's its verdict. According to research from the Federal Reserve Bank of San Francisco, every single one of the last 10 U.S. recessions, going back to 1955, was preceded by an inverted yield curve. Short-term rates rising above long-term rates, 10 for 10, over 70 years. And right now, in late July 2026, the curve is not inverted. It's normal. Which means that by the single most reliable recession predictor available, the bond market is not currently flashing a recession warning, even with a war pushing up oil, even with the inflation gauges at war with each other, even with a weak June jobs report. So there's your answer to the question we opened with. Crash or calm? The one signal that has never missed in 70 years is saying calm, and for now, not everything's fine forever, just the recession alarm that has gone off before every single downturn since 1955 is silent today, no matter how loud the headlines get. Sit with that for a second, because it contradicts almost everything in your feed right now. So far, this has been about reading the market. From here, it's about reading your exposure to it. Because these same forces are already sitting inside your mortgage, your savings account, and possibly your retirement fund, whether you've checked or not. And this is where that third number I promised comes in. The one your lender will never volunteer. Back to that $400,000, 30-year mortgage. At today's average, near 6.55%, the payment is about $2,542 a month. If the 10-year Treasury rises another half a point this year, well within the range these competing forecasts imply, that rate could climb towards 7.05%, pushing the payment to roughly $2,675. That's about $133 more every month, or nearly $47,900 more over the life of the loan, for a rate move that could plausibly happen inside a single quarter. This isn't a textbook hypothetical, it's the exact fork the bond market is debating right now. And the third number that decides it is the spread between your mortgage rate and the 10-year Treasury. Watch that spread, and you'll know whether your quote is fair before your lender does. While all this plays out, there's a bigger number sitting underneath it. The U.S. national debt just crossed $39.4 trillion, growing by roughly $6 to $7 billion a day. 5 years ago, the average interest rate the government paid on that debt was about 1.5%. Today, it's about 3.4%, more than double. That single change is why interest costs now consume close to 14% of all federal spending, according to Congressional Budget Office projections, and why that share is expected to keep climbing. Every basis point this year's rate debate adds or removes doesn't just move your mortgage. It moves the interest bill on $39 trillion, which eventually shows up in future tax and spending decisions too. To make that concrete, 5 years ago, the government paid roughly $580 billion a year just in interest at that lower rate. At today's average rate, the annual interest bill is well over $1 trillion, on debt that itself has grown by nearly $11 trillion in the same 5 years. The debt got bigger, and the price of carrying it more than doubled at the same time. That's not two problems. That's one problem, compounding. This same rate environment is reshaping the housing market itself, not just the cost of a loan. The median price of an existing home just hit an all-time high, above $440,000, while the number of homes for sale barely moved versus a year ago. Normally, higher rates cool demand and bring prices down. This year, elevated rates and record prices are happening together, which tells you something specific. Millions of homeowners locked in a rate near 3% during the 2020 to 2021 window, and they're refusing to sell and trade it for today's 6.5% plus, even if they'd otherwise move. Fewer sellers means less inventory, and less inventory keeps prices high even as borrowing gets more expensive. That's the bond market reshaping buyer and seller behavior, not just monthly payments. With inflation still running above the Fed's 2% target, there's one government-backed option built for exactly this situation, and almost nobody uses it. Series 1 savings bonds pay a composite rate that adjusts directly with inflation, reset twice a year. When inflation runs hot, the I-bond rate runs hot with it. No guessing, no forecasting, it's mechanical. The catch: a $10,000 per person per year limit through Treasury Direct, and your money is effectively locked for at least a year. But for the portion of your cash meant to keep pace with rising prices rather than chase yield, it's one of the few instruments where the government is contractually on the hook to match inflation, dollar for dollar. Here's a number you can act on today, not in some hypothetical future. Money in an average savings account is still earning a small fraction of what's available elsewhere. 3-month Treasury bills currently yield around 3.7%. Top high-yield savings accounts are paying similarly competitive rates. Both are about as safe as it gets. Treasuries backed directly by the U.S. government, FDIC-insured savings protected up to $250,000 per institution. If your cash has been parked far below that, the bond market's current pricing is quietly leaving money on the table every month. It stays there. This is exactly why I check the 10-year yield and the shape of the yield curve before almost anything else in the news. It takes 5 seconds, and this year more than most, it tells you more than the headlines do. So here's what's worth doing this month. If you're shopping for a mortgage in the next few weeks, know the rate you're quoted is tracking a 10-year yield reacting to a live geopolitical situation. It can move meaningfully either way on short notice. If you hold bond funds in a retirement account, check the duration on the fact sheet. Anything above 7 will move noticeably if this year's rate debate resolves toward more hikes. If you're holding a meaningful cash cushion in a low-yield account, compare it against current T-bill and high-yield savings rates. The gap right now is real money, not a rounding error. And whatever the Fed decides on July 29th, remember, this isn't a single make-or-break event. A live conflict, 2 inflation gauges pulling opposite ways, a cooling labor market, and a new communication style with fewer advanced signals are going to keep interacting for months, not days. Most people experience all of this as noise. A war on the news, a jobs report, a Fed statement, a mortgage rate that moved for no obvious reason. It isn't noise. It's one market following one rule, reacting to real events in something close to real time. You don't need to predict the next headline. You need to know which 3 numbers to check when it hits, and now you do. The yield curve tells you whether a recession warning is actually flashing. The gap between short-term and long-term Fed expectations tells you how confident the market really is underneath the competing opinions. And the spread between your mortgage rate and the 10-year Treasury tells you whether your quote is fair or whether it's time to shop around. We opened with one question the news couldn't answer cleanly: crash or calm? Now you can answer it yourself. If reading the bond market this way actually made it click for you, that's the whole point of this channel. Every week I take the one number that just moved, your mortgage, your savings, your retirement account, and I translate it into what to actually do about it before it turns into a headline everyone's already panicking over. This year especially, these signals are moving fast, and I'd rather you hear the math walked through calmly than catch a scary headline with no context. So hit subscribe, turn on the bell, and you won't miss the next signal when it moves. Subscribe, and let's read this market together all year. Next video, I'm going deep on the July 29th Fed decision itself, walking through what a hike, a hold, and a cut would each do to your mortgage, your savings, and the stock market, so you're not caught off guard no matter which way it breaks. If this made the bond market feel less like background noise, drop a like, or better, tell me in the comments which of the three signals you're going to start checking first. I'll see you in the next one.